the issue is the level of skill. Yeah. So, I mean, if you're the best trader in the world, I mean, I'm sure that I can give, my assistant, Mark Ritchie, I could give him $10,000, and I'll bet you in 10 years from now, he's a rich man, so, and if I gave him 100,000 or $1 million, he'd be even much richer. But I can give, there's certain friends of mine and members of my family that I'm sure if I gave them $1 million today, they'd be broke in a couple of years trading.
Hello, namaskar, hello, how are you doing, guys? Face2Face Global once again, and this time is going to be very, very special. Well, every time I say the same thing, this time is going to be special because every time we are raising the bar for ourselves and we are trying to give you the best content available from everywhere around the globe. As you can assume, this is a Face2Face Global, and the expert today is going to blow your mind because what he has done in his illustrious 40 years of career is not a joke. For people like us who aspire to become amazing traders, he is like an icon. He is subconsciously mentoring a lot of people through his books, and I can't wait enough to have an interaction with him. And this time what I did was, while I wanted to have an interaction with him alone, I realized that it's not possible for me to do it alone. So I invited one of his favorite students from India to join me and get the best out of this interaction. But before I call the student, let me talk about the person who is an expert today. His name is Mark Minervini. I'm sure you must have heard this name. He is quite a reputed name in this industry. He is one of the greatest trader of this generation with over 40 years of rich experience in Wall Street. And his career has been incredible. I mean, performing an average CAGR of 220% and only one losing quarter in the last 5.5 years. This is not a normal achievement. He's also author of multiple books, Trade Like a Stock Market Wizard, Think and Trade Like a Champion, Mindset Secrets for Winning, and so on. I mean, he was also part of a book, Market Wizards by Jack Schwager, whom I also interviewed as Face2Face. So he was covered by Mr. Jack Schwager as well. And he has been US investing champion in 1997 and 2021, which is very, very big thing in US. He gained 335%. It's not joke. I mean, we are talking about serious money, guys. And the guy who has done this and who has done phenomenally well is going to be our expert. Is going to be our mentor for another hour or so. And we'll be joined by, as I said, his favorite student from India who has done equally well, if not more, Ashwin Porwal. Ashwin, how are you?
Hi. Good, Vivek. I'm good. How are you?
All well, fantastic. And I'm so excited that I met you in one of our face-to-face events and we connected well. And I requested you that we should have your master also come down and we talk about his strategy, his style, and you can ask your advanced questions. So I'm so excited looking forward to this conversation.
Vivek, I am also excited and thrilled to be the part of this interview. No doubt, I attended MTP at 2017. In the last 5 years, my journey was excellent. The impact of Mark books, Mark Master Trader program had a big impact on my trading account, my mindset, my thought process. I developed myself as a super performer, I feel, and I'm still trying to match what Mark had taught us in his books and seminars and webinars. So thank you for calling me here. Thank you.
Thank you, Ashwin Bhai. And I know your performance. I know you. So I will say that, yes, you are one of his favorite students and you keep on doing the good work. And thank you for accepting this invitation of coming on the front and talking about yourself as well, because it's not such an easy thing to do. And you have accepted that invitation. Thank you.
We want to see Vivek Bhai a lot of good successful trader in India also. That's why its interview is very important, I guess.
Yes, it is important. So guys, hold your breath. And here we go, an interview with Mark Minervini. Welcome, Mark, to my face-to-face series. It's absolute pleasure for me to interact with you. as part of the face-to-face series, I've recorded almost 170 interviews from traders all over the world. And I'm sure this one is going to be my favorite because subconsciously you all are a mentor for all of us. Just a small thing before I invite you for this interaction. Dear learners, there are many content around Mark, which is available in multiple forums, including his lovely books. So we are not going to cover the basics since I'm there, and one of the favorite students of Mark from India has also joined us. We will try to get the maximum out of him, and it's going to be beyond basics. So I hope you're going to appreciate this. Mark, hello, hello, how are you?
Thanks for having me here. I appreciate it.
I'm very excited and I'm very nervous as well because it's kind of dream come true for me. Very happy that you agreed to do this and you are interacting with me and Ashwin.
It's my pleasure.
So Ashwin is one of your favorite students from India. So I thank him also for connecting me to you and becoming part of this this interaction, because I'm sure Ashwin can get the maximum out of you. So before I give Ashwin the opportunity to interact with you more, I have my basic question with you, and I want to start with failure. Everyone starts with success, and we all know your success story. But I'm very curious to talk about your failure first, because every trader I've seen eventually becomes very big or successful when the person sees the failure in his or her life. I want to start with your failure. What was your major failure as a trader or as a human being? And what led to that change inside you and you are doing what you are doing?
Well, I mean, I don't think I had a major failure as a human being because, I keep learning and I always strive to do better. And ultimately, I've accomplished most of my goals. So, I mean, there has been lessons along the way. So I think the first and most important thing about failure is to not view failures as failure. So I would say that's the first lesson is, to look at, there are no failures, there's just results. So way back, when I first started as a young man, and then I started trading and so forth, I got interested in Tony Robbins at the time and read Unlimited Power, went to a Tony Robbins seminar. And that's where I started thinking that way, where, he said there's, you're just going to get results. There's good results, there's bad results, but in every result, there's lessons. And so, yeah, that would be the first thing. Now, but I produced terrible results for many years, and like most traders, some people get there quicker than others. I took me a long time. At the time, there wasn't much help. There wasn't this type of things that we have now, where you have videos and you have a lot of mentorship and lots of great books. Back then, the books weren't so great. They were outdated. There was a lot of information that just wasn't. It wasn't what the books that were written were about strategies that never worked in the first place. So information now, the problem you have now is you have too much information. So now you've got to sift through and figure out what's the good information from the bad information. So I did terrible for, if you want to call it a failure, for a good 5 or 6 years. I didn't even make any money. And so that was, and I made every mistake that you could possibly think of. And we'd have to sit here for hours to go through all the mistakes, as I made every one of them.
True. So the initial 4 or 5 years which you went through, did you also went through that phase of literally bankruptcy, that you didn't have money at all and then you had to start from the scratch again?
Well, I mean, I started with nothing to begin with just a few $1,000s. So I never, when I had the few times where I blew my account up, it wasn't much money. The first time was $2,000 or $3,000 or $4,000. The second time was a lot more. It was maybe $20,000 or $30,000, and at the time, that took me a long time to save that money, to trade that money. So it might as well have been 3 million, or 10 million, because it was everything that I had. So yeah, I mean, that was, and I actually, the time that I blew up the biggest was when I started listening to a broker, and I wasn't even really on my own trading. It was more that I listened to a broker, and then he told me to do these really terrible things that I would never do today, and that was to keep adding to a stock that was going down. And then we just averaged all the way down until the stock went to under $1 and then eventually went out of business. And so that's where I learned, that's probably where I learned, my biggest lesson was to not average down into stocks, was because right early on, that's how I blew up.
All right. Ashwin, over to you.
Thank you, Vivek, for making me the part of this interview. And I'm taking the interview of a person who is guiding me directly, indirectly from last 5 years. So, hello, Mark. My first question is, in the introduction of your first book, Trade Like a Stock Market Wizard, you talked about appropriate preparedness. So, which type of preparedness you are talking about? You also mentioned that you have attended more than 50 seminars like Tony Robbins did. And what kind of transformation does this bring to a person which makes him a better trader?
Yeah, so Ashwin, it's good to be here with you. I haven't seen you since the Master Trader program. Yeah, I know, mentioned that you're one of my favorite students, if you will, and that's true, for several reasons. One, you're really smart and you're a great trader, but you're also a very sweet person. So really great to be here with you. As far as preparedness, I went to every seminar I could. I spent my last dollars on, going to Tony Robbins seminars, I went to O'Neill seminars. I went to every seminar you could think of. I bought every book. I just kept spending money, and I felt like it was an investment, in myself. Even I know nowadays a lot of people will say, I can't spend that money. It's a certain percentage of my account, and then I'd have to cover that, with my trading. But you're kind of thinking about it the wrong way, because you go to Harvard, you go to a college, and you spend all this money to be a doctor. You're not getting paid. You have to make that investment in yourself. And I realize, people look at it as that money's their tool, but that tool's not going to do any good if you don't have the right information. If you're not trained properly, then it's like giving a brain surgeon a bunch of tools, and you're not going to make it through that operation, if he doesn't know what he's doing. So the training is most important, and investing in that. The money's the least important issue. I mean, if you have the, and I know, Ashwin, you had some really big years where you turned an amount of money, into a much larger amount of money. So if you have the skill, you can always, work, get some money, and then grow it. But without the skill, it doesn't matter how much money you have. You'll make nothing, or you'll lose money. So what you said about preparedness, I'm not sure what your question was specifically about preparedness. What was your question? I'm sorry.
So what kind of transformation does being a person which makes you a better trader with that preparedness?
Yeah. Well, over the years, I've worked out my sort of what I call my playbook, to where I really have a response for every eventuality. It's what I call contingency planning. And it's no different than, right now, I'm sure, the US is completely prepared that if, Russia launches a nuclear weapon, they already know what the response to that is going to be. Mm-hmm. They're prepared for every situation. And for the situations that you're not prepared for, once that happens, you figure it out and you say, this is what I should have done. And you add that to your playbook. Over years and years and years, eventually you're going to have a playbook that's, got pretty much everything covered. So, and that's what really gives you a lot of the confidence too, because now when your worst case scenario, what you're going to do if this stock goes down, what happens if your internet goes out. Now you have the confidence to make very bold moves, because they're not very bold anymore. They're only bold when you don't know. As Warren Buffett said, the risk comes from not knowing what you're doing. It also comes from not knowing what to do in certain situations, and they arise out of nowhere, and there's some surprise. There's very few things that can surprise me in the market. So that's where, what everybody should move towards, that and building that playbook of their own.
Perfect. So for the growth stocks you follow, basic fundamentals, that is sales, profits and margins. Anything else we should check in fundamentals?
Well, the thing is, when you're dealing with growth stocks, what's important is growth, and earnings are driven, by sales, and margins. If you have margins expanding and sales growing, you can have very explosive earnings. So, I don't really use a whole lot more than that. I mean, I have various ways that I slice and dice and look at those metrics, but it's mainly earnings, sales, and margins. You can get into things like, return on equity, and that's needs to be compared industry group wise, because a return on equity in one group, in a software group, is going to have very high return on equity. Even margins, like a biotech may not have any earnings or sales at the moment, but if they get a blockbuster drug, it'll be 80% margins, and they'll be doing, they'll have billions in revenue coming in. So you got to categorize the situation and then decide how you're gonna, look at it. So the ways that I slice and dice that are all explained in my first book, which my second book doesn't contain any fundamentals, but the first book does. Fundamentals to focus on is one of the chapters, and that shows the various ways that I slice and dice that. Really, I would rather see someone, or the way I do it is I'm a real expert at analyzing those metrics, and I don't really need anything else. It's like I don't need to know book value and even valuation. Valuation is going to work itself out. So people try to value the stock, but when you go into stocks that have very high growth rates, or even have the potential for high growth rates, the analyst can only see so far out. Even the CEO of the company doesn't know what's going to happen a year from now. So when the growth is real high, the analyst can't put an appropriate valuation on it. So, and that's what creates the inefficient pricing. And that's why it's important to go with stocks that have very high growth rates or have the potential for high growth, because now there's inefficient pricing. And that's why a stock can go up for years. An Amazon can go up 80,000% over a decade because it's inefficiently priced because of the growth rate.
All right. Mark, first of all, thank you so much for sharing your playbook in the form of your lovely books. Literally, we have read your playbook through your books, so thank you so much for that. In your books, you have harbored a lot on risk management. And, we all understand the importance of that for being a trader. There are a lot of learners in my platform who are first-timers in the last 2 years or so, and they probably have not gone through the entire text of your book. So just few minutes on your risk management principles. I know it may be repetitive, but still, for the sake of my learners, if you can spend a few minutes on risk management principles, right?
Well, there's a reason why, in my first book, there's 2 chapters. There's a double chapter on risk management, and David Ryan, who wrote the foreword to that book, he said you should read those first, because they are, it is the most important topic in trading. So it's all about risk management. So it starts off with the first thing is knowing where you're going to get out before you get in, and really having that plan. And risk needs to be managed in a number of ways: position sizing, stop losses, not when you get fully exposed, to not allowing too much drawdown from peak on positions, not averaging into losing positions, only buying in the direction of a trade, or if you are buying on a pullback, make sure it's turning back up before you start getting involved. Or certainly if it is going down, and you're buying into that, you're going to have some point at which you say uncle, if they twist your arm too far. It comes down to math. Your gains have to average more than your losses, or you're not going to make any money. It's that simple. It's no different if you're playing poker. Your winning hands are going to have to average more than your losing hands. So, that risk reward ratio, that's the holy grail. The holy grail in trading is your percentage of winning trades times your batting average, divided by your percentage of losing trades, or your percentage of winning trades times your average gain, divided by percentage of losing trades times your average loss. That's the holy grail. Get that right, and you're a successful trader. Then, depending on how big that risk reward ratio is, that's your edge, right? So adjusted for batting average, let's say it's 1.5 to 1. Well, a day trader might have a 1.1 to 1, and a long-term investor might have a 3 to 1. So depending on how big that ratio depends on how much turnover you have to do. So those are the 2 metrics, that you're going to manage that risk in relation to reward. And then when you get that final number, now you got to figure out, okay, how many times do I have to do this to get to my goal? And that's the mathematical equation, beneath all the cups with handles and the VCP patterns and all that stuff. It comes down to math. And so there's the risk versus the reward.
Awesome. We got the holy grail today. One more question from my side. Market always gives swing opportunities in every market conditions. and there are new leaders who emerge, who lead the new swing of the market. How do you identify those leaders early on? Because the big money can be made if you can identify these leaders early on.
Well, identifying them early on is actually the easiest part. It's the later stages which becomes more difficult. If you're starting to look for those while you're in a bear market like we are right now. I love bear markets. This is my favorite time because this is where, I mean, I'm in cash. I'm always in cash in a bear market because I have stops. So I'm going to automatically be forced to cash. And at this time, and I just did recently, I don't know if it's still on YouTube, but if it's not, I'll put it back up. There was a webinar that I did was how to spot leading stocks in a bear market. So you should definitely go look at that because I cover this topic. In the bear markets is when I look for what I call the sore thumbs, because leaders stick out like a sore thumb. When the market's going down, you can see the stocks that are not going down as much or going sideways or even going up. And when the market's in a downtrend, I'm looking for the stocks that are in an uptrend. So that's where the leaders really start to, show themselves. Later on, as the market broadens out, you get lots of stocks are moving up. Yep. And now it gets more clouded. And then you start by default buying laggards because now maybe you've traded out of some of the first movers, you've taken profits, they're too extended, and now you keep trading into more and more names, and before you know it, you're in the laggards. So the best time is during corrections, is to look at what's doing the best relative strength, new high, look at the relative strength line, and is it hitting a new high while the market is correcting? And those are the ones that you want to watch and wait for them to form bases and then break out of the bases. And hopefully they have the earnings and the sales also.
Correct.
So we are talking about the corrections. So which screening the leaders during the correction that we discussed already. What is the importance of why your 50-80 rules is so much important in the correction?
Well, the 50-80 rule couldn't have been any more, couldn't be any more true than this last environment, or the environment that we're in now, which is, the correction, of course, that started in 2021, went over to 2022, where you've had an enormous amount of stocks down between 50 and 80%. So the 50-80 rule just says that a secular leader, some like the big leaders that have led for a long period of time, when they top, 50% of them are going to go down 80%. About 80% of them are going to go down 50%. The average decline is going to be somewhere in the neighborhood of about 70%. And that's based on history and my own anecdotal evidence of 40 years of doing this. And we've got so many stocks that are down 50 to 80%. You've got big cap names like, Facebooks and PayPals that are down, really big, and some other names that were more speculative that some are down 90%. So those are the stocks that you want to stay away from. Those are the past leaders. And when you have stocks that are down 80%, the chances of that turning into a new leader is very, very slim. You want stocks that had not corrected that much. And that's where you're going to focus on, in a bear market. And that's where sort of you separate, what you're going to stay away from and what you're going to look at. You're looking for the stocks that correct it the least amount, not the most.
Yep. And accountability of our trading results is very important, and for that we maintain our journal to create an edge. And you talk about that most of the trader in the world, their betting average is between 45 to 55% or maybe 60%. So create that best edge. What could be the best ratio of an average gain? 1:3, 1:4, 1:5. What could be what is your pick on what could be the best ratio, risk reward ratio?
What's the best ratio?
Yeah.
Well, you want the ratio to be as big, as high as possible. The bigger the ratio is, the wider the ratio that you keep your reward versus your risk. So let's just say you average 15% on your gains and you average 5% on your losses. So that would be a 3-to-1 ratio, right? So that's going to allow you to have a much lower batting average and not get in trouble more than if you had a 2-to-1. So if you have a 2-to-1, now you're going to have a higher batting average to get the same results as if you have a 3-to-1. So the batting average, the way I do it is I want to be able to to be able to sustain a batting average of 25% and still not get myself into trouble. 25 to 35%, because in a bad market, my batting average goes down sometimes to 25%, where even sometimes lower, where you're wrong, 8 out of 10 trades. So that's where you got to be able to sustain that, because that's going to happen at some point. And so if my reward to risk is 2 to 1 or 3 to 1, well, then I'm not going to get in much trouble, even if I have the batting average. And when things turn around and my batting average is doing well, like in a really good bull market, I'm in the 65, 70% range for certain periods. Now I'm making tons of money, because now that ratio is going to really start adding up.
All right, Mark, I have a question, follow-on question in that. Whenever we are executing a trade, at that moment, do we think about these ratios, that for this trade I can expect 1:2, or for this category I'll expect 1:4, and your capital allocation is also different as per the risk reward ratio?
That's a great question. So, and I always say, you want to let the math make its way, let the spreadsheet make its way into your trading. So to a certain extent, yes, you should have that math in the back of your head. But here's what happens. So you're in a trade, and let's just say it turns into a loss, because this is where the real trouble happens, is when you have losses. The gains sort of take care of themselves, but handling the losses is really where the real trick is. So now you're at a loss. Let's say stock goes against you. It's down 4 or 5%, right? Starts going down a bit more. It's down 6%, now 7%. Well, this is the time where you have to know in the back of your head, what is my average gain? What is my batting average? Well, my batting average is about 45, 50%. I'm right about half the time. And not mine, I'm just saying hypothetically. And my average gain is 12%. Well, the closer that gets to 12%, there should be an alarm going off in your head saying, I can't take more than 12% losses, or I'm a loser. I'm a losing trader, right? Now the risk reward, the reward risk ratio is inverting. So you need to be definitely cognizant of that, and trying to keep that. You want to keep your loss as tight as possible, and you want to keep your gain as big as possible. At some point, though, you're going to optimize those numbers. If you've been trading long enough, your strategy is going to get to a point where you pretty much you get the most you can on the upside in good markets, and you keep your loss as small as you can, with balancing it between being too tight and choking off the trade, or having too large losses and having them affect you negatively. So, you just have to be aware of that, and then constantly strive. Now, here's another thing too. Let's say you're at a gain. You're at 20% gain, 25% gain. Your average gain is 12%, right? So now the stock comes back down. Well, once you're above your average gain, what happens to your average gain? It improves.
Yeah.
You're helping your average gain, and that's the goal. The goal is to get your average gain as big as possible. So as it comes back down, you got to be thinking to yourself, do I want to let this slip below my average gain and now hurt my average gain? So now you go into that profit protection mode, and that's a good number to be protecting and trying to improve above. So again, knowing what your average gain is lets you know how to manage those gains above those levels. And again, being cognizant of those numbers and letting the numbers make their way into your trading. Yes, it's important.
Excellent.
If you allow me to ask this question, what is your average gain? I mean, you may prefer not to answer. I mean, it's your choice.
Yeah, well, it changes. I mean, long term, my average gain runs in low double digits. I'm much more of a trader now than ever. In 2021, I didn't do the numbers, but it was definitely in the single digits, because I was trading everything at the strength, 5, 6, 7, 8%. Like if I got 12 or 15% gains, that was huge, because you just weren't getting those gains. And that's another thing too. You have to, the theme of the market's important. That was the theme in 2022. The theme was what I called pop and drop. They would take off for a few days, and then they come in, and before you know it, you're at a loss. So in about February, I said, you know what? I'm just going to sell into that first move up, keep my stop real tight, and trade a lot more here. and take big positions, and I can get to that big number. And when I start selling these stocks and they keep going higher and I wish that I held them, then I'll think about changing. It never happened. It still hasn't happened. It's been a long time now, and we haven't gotten that sustainable. And that was one of the main things that told me we were late stage in the market and to start looking for a bear market, because that was the early warning, if you will.
So do you make more money in bull market or in bear market?
Oh, I definitely make all my money in bull markets. In bear markets, I'm in cash, and I'm usually not trading at all, or I'm trading with a very small portion of my capital just to keep a finger on the pulse, so to let me know when I start gaining some traction, and then I can start putting more money into the market and getting aggressive.
So Mark, you are known to be in cash, because you are known to identify bear market quite early. But a normal trader who has come into the market after 2020, they've only seen literally the bull market. At least in India, we are still seeing the bull market. In US, the situation is different, but in India, we are still growing.
Right.
How do such inexperienced trader hold on to the gains which they have gained? Because most of the time I see, and I get emails from many people, that I made money, but I lost that, and I actually lost more because I got very greedy. So how do you exit, or how do you retain that gain which you have made in last 2-3 years?
Yeah, well, getting greedy is definitely is a big problem, and so, you have to realize that your number one, your profits, you have to nail down your profits. You have to monetize those trades and sell those stocks and maintain those profits. But if you just keep trading, a lot of people just want action. So even when the market turns against them and that theme changes, and a lot of people during 2021, even though I repeatedly even told my own clients and put on Twitter that this market is giving you a very small amount on the upside, you've got to adjust your techniques to either sit in cash and wait, or you've got to take down your expectation and tighten up your stop and recreate that risk reward ratio in a smaller window for a smaller a number. And a lot of people just kept over and over and buying the breakouts, right, but then waiting for a bigger gain and not adjusting, and now it turns into a loss, and they get death by 1,000 cuts because they have so many losing trades. The other person is the type that gets the big gains and then lets the stocks come all the way back down. They had a big profit, and then they sit with it, and it comes down, and they go, oh, well, I wish I sold it at 100. Now it's at 80. And then it goes down to 70, and if it just goes back to 80, I'll sell it. And then it goes back to 60. And before you know it, well, it's too late to sell now. I gave back, half of my gain. I might as well hold it. And before you know it, they're back to break even and taking a loss on the trade. So that's something that I did early on, where I'd give back big gains. I would have a big gain, and then I would give it all back. So again, you have to have rules, and say, well, I'm going to protect. I'm not going to let but X percentage of my gains be given back. So there's a lot of rules that have to be developed and used homogeneously to protect yourself.
Sure. Ashwin.
Perfect, Mark. So, Mark, apart from being a US investing champion twice, you are a good drummer, you are a pro photographer, you are a fine shooter. So, what drives you to become a best version of yourself in whatever activity you do in your life?
Well, I just feel like, anything you're going to do, you might as well do it right. I mean, it only takes a tiny bit of more effort to do things really well than to do them half-ass, So, that's the way I've looked at it, as that I noticed that, to do something mediocre, it takes still quite a bit of effort, and just a little bit more effort, and you could be really good at something. So, and I just, that's why I wrote the mindset book, because that really, over my years, I'm 57 years old, and I've been trading for 40 years. I've developed a lot of ways to deal with emotions, and to to practice, and to use universal principles that you could apply to anything. So I studied very early on. When I was very interested in when I first started trading, and when I was just a teenager, and going into my early 20s, I was really interested in champions, winners, and what they had in common. Sort of like, what we did with O'Neill and myself did with stocks. We looked at stocks and said, what did the best stocks have in common? And then look for those characteristics going forward. I did the exact same thing with people. I studied Olympic champions, the top business people, and said, what do they have in common? And what's the psychological profile and so forth. And that's what's in my mindset book is not only all that I found and learned, but what I've developed and used for myself. So, it's just simply, like I said, doesn't take a whole lot of effort to do things good, more than it takes to do things mediocre.
Awesome.
That's excellent book, definitely. So you do a lot of visualization, I know. And how much is the process of meditation or visualization helpful for a trader?
Well, again, that contingency planning that I was talking about earlier, where you have a plan for each thing and really know, how you're going to respond. So if you start getting into a habit of visualization, you'll start to do that in your whole life, where you'll start to have contingency plans for things. And again, it helps with confidence. It helps with moving through life with more confidence and making more decisive decisions and taking more risk, being more, going into taking on new things, because you feel more in control because you've rehearsed it already. So this is when, people get scared when they have unknown factors. So then they freeze up because they don't know what to do. They're not sure what to do. This insecurity because they don't know what to do. So when you've rehearsed it already and you've been through it, you not only know what to do, but your nervous system has experienced it already. So you're calmer and you're able to, and so I do that. It's just become really sort of an axiomatic or automatic thing that I do. I do lots and lots of visualization. You talked about shooting. Visualization was huge, and mental rehearsal was huge. It was a very, very stressful situation when you go into a shooting competition. You're running real fast with a loaded gun. If you could draw it and shoot yourself in the foot, you can trip and fall, and it's very dangerous. So you really try to map everything out. So it's just become, I do visualization and mental rehearsal every morning when I get up, and I do it at night before I go to bed.
Awesome. Mark, I want to ask you a few questions from small trader perspective. Ashwin is anyways a very big trader and is making good money. So he's asking you questions as a professional, but I still want to go and ask basics. So there are many people with small capital these days. And thanks to COVID, not many people have come in the system, and they're using instruments like options, crypto to trade. Because they have small capital, they can't trade heavy instruments like cash market or futures. Any suggestions you have for them with small capital? Can they think of becoming big with small capital?
Are you saying small cap stocks?
No, I'm talking about small capital. People.
Small capital, yeah, small traders, yeah.
And they're using leverage instruments like options and crypto to trade the markets.
Right, smaller accounts, yeah. Well, look. Bottom line is, look, if you don't have skill, you can start with a big account, and it'll turn into a small account. So, and if you have really great skill, you can start with a small account and turn it into a big account, and a big account into a huge account. So the account capital is not the problem. The issue is the level of skill. So, if you're the best trader in the world, I'm sure that I can give, my assistant, Mark Ritchie, I could give him $10,000, and I'll bet you in 10 years from now, he's a rich man, so, and if I gave him 100,000 or 1 million, he'd be even much richer. But I can give, there's certain friends of mine and members of my family that I'm sure if I gave them $1 million today, they'd be broke in a couple of years trading. So, or maybe even much sooner. So again, like I said before, you got to get the knowledge, you got to get the training, and then money's the least of the problems. That's what everybody's worrying about, the money. And that's one of the early things that I did after years and years of not doing well. You talked about failure. I said, you know what? I'm going to stop worrying about this money, because I was like just keeping score and going, oh, every year I didn't do well. Oh my God, I'm just so behind the curve. And, and I just felt like I was getting further. I was like in the ocean, just floating further and further away from land, when in fact I was getting closer and closer, because I was getting experience and I was making all the mistakes, but it didn't feel that way. So what I did was I said, I'm just not even going to keep score. I'm not even going to worry about how much I took off my screen. You had that little ticker. This is when I finally started getting quotes, and they had the little ticker in there at the bottom where you can see like your count of value and how much you're up or down. A lot of people have that on their screen, and then all day they watch it. And then as it starts going against them, that's how they get panicky, when they start seeing, that number. I took that off my screen. I stopped looking like daily my P&L, and I just said, let me just concentrate on making really great decisions and being the best trader I can be. And my goal was to be the best trader in the world and to make every single trading decision a quality decision. I said, I'm just going to focus on the process and getting this process down and breaking it down into each individual thing. Okay, am I buying perfect? All right, at the right spot? Is my stop tight enough? And just worrying about those things. When I started just getting those right, all of a sudden the money started coming in, and I started making money, and my capital grew. And I took a very small amount of money and turned it into a very large amount of money.
Yeah. So, let me elaborate that question further. That a lot of new people who have small capital, they are using instruments like options to trade.
Right.
Those options have potential to absorb smaller capital. Do you think that's a good idea, or one should only focus on cash market?
I meant to talk about the options, and I forgot you said that. Yeah, it's a very good question, because you're right. There's, when you have the smaller account, you start thinking you need to use leverage, and so you start gravitating to those products, and you start using, much more risky things. The problem with options is, and I know there's some people out there that do well with options, but the facts is that 99.9% don't and will never will, because options for most is a sucker's bet. You have so many things working against you. You have got time value. You've got the spreads. You've got the premium. The real problem is the options market is just like going to the horse track. When you go to the horse track, you bet on it's say 10 minutes before post. The horse is 8-1. You bet it at 8-1, right? Now, 10 minutes later, the gate opens, the horses come out. Guess what? The horse goes off at even money. Imagine that. You were promised 8-1, but you got even money. Now, because based on the betting, they changed the odds. How nice it must be to be on the other side and change the odds, take people's money and then change the odds based on how the money's laid. So that's what the options market does with premium. So as the stock becomes more volatile and things happen with the price of the stock, now the premium balloons, all right, or shrinks, and that's why options are so difficult. And to answer your question, new traders should absolutely stay away from options and any type of leverage whatsoever until you can double your capital, on a cash basis. You have no business using, margin or certainly not using options.
Sure.
Now, I used options very early on, but I could tell you that all the returns that you read about and all the success I've had, none of it comes from options.
Great. So from your book, Mindset Secret for Winning, I like chapter 3, Building Self-Image of a Champion. So a trader learns various trading methods and risk management strategies, but because of his own poor self-image, he fails in the market. So why building self-image is so important?
Building self-image?
Yeah.
Well, so in a number of ways. I mean, first of all, you have to have confidence. If you don't have confidence, you're going to have a very hard time doing anything that requires making a decisive decision and pulling the trigger under pressure. So, there is a lot of pressure. It's like trading is sort of like being, in a big, every day, is like being in a big championship game, and they give you the ball and you've got to make the winning shot. That's, you know, to a lot of people, that's what it feels like. It feels there's a lot of pressure on each decision. Doesn't need to be that way, but that's how you feel. Early on, you certainly feel like that. After you've been doing this as long as me, you know, I don't feel that way. But I did for a long, long time. So yeah, so your self-image, and also it's about feeling deserving. You know, you're not, if you're not going to make, you're going to self-defeat yourself. You're going to self-sabotage yourself if you don't feel deserving. If you feel like that's just the way we work. You know, that you may be able to overcome your subconscious undeserving programming, maybe for a certain period of time, but ultimately we come back. The subconscious really runs everything, and so now that comes a lot of times when you start off poor, like me. Like I started off very poor, so I had what I call a poverty mentality. Even though you know, you're doing well, you don't even believe it. You know, you don't believe maybe you deserve it because you're just conditioned to not doing well. Your parents weren't rich, and you're asking yourself, why am I doing well? I'm not supposed to. I don't have the Ivy League education. So that's where it becomes very important. But the thing is that if you're putting in the work, you put in the time, and you work hard, you know, you do deserve it. You do deserve success. And even if maybe you have a heinous past and you've done terrible things, but if you you know, if you forgive yourself and you turn a new leaf, you know, you do deserve good things, and you should you know, move forward with that feeling. Again, my book, I talk about this, you know, in the mindset book, because it's a lot easier said than just turning on a switch if you don't know how to change your mode of thinking and what to focus on. It's all about, look, everything in the world, you know, that we do and that what happens in our life is basically guided by a couple of things. One is what we focus on, and the choices we make, and what things mean to us. What does it mean to us? So changing the meaning, you know, of, you know, to me, I look at my meaning is that I'm incredibly deserving because I actually started with nothing. So I think I'm more deserving than someone who grew up with an Ivy League education, because they had more to work with than I did. So, you know, so I actually flipped that around. But in the beginning, I didn't feel that way at all. I felt like I was undeserving because I was from poverty, and why should I be rich?
What a beautiful heart. Amazing. I mean, it's such a lovely perspective you have given. Mark, we have just, I mean, we related this one. We have just crossed 45 minutes. If you allow us another 15 minutes, we have a couple of questions, not much more. 15 minutes is
Yeah,
okay.
sure. Yeah, that's fine.
Okay, great.
So I had learned, Mark, I learned super performance from you, and from your book, Think and Trade Like a Champion. My favorite chapter is chapter 10. That is 8 keys of unlocking super performance, and chapter 11, that is champion trader mindset. So out of these 8 keys, I feel I still feel challenge in concentrated portfolio and selling into strength. Also, you never chase a stock more than 5% from the breakout point. So how to reach that 25% position size in a particular stock in our portfolio? First. Second, what gives you such confidence to take a big position in a single stock and selling it into the strength?
So I got to break this down a little bit, because you talked about a number of things. So selling into strength, that's an easy one. What was, you said just before that though? What was the first thing?
Concentrated portfolio.
What was it?
Concentrated portfolio.
Oh, right. Okay, so concentration, right? Taking a big position.
Yeah.
And selling into strength.
Yeah.
So, okay, so they go together, because if you take a really big position, selling into strength, like a smaller gain makes a much bigger impact on your portfolio. So I'm not that worried about, you know, people don't sell into strength because the stock's going up and they get greedy. You know, they say, you know, the stock's going to the moon. I'm in Tesla, you know, whatever it is. So to me, though, if I take a really big position and the stock goes up 10, 15, 20%, well, that has a big impact on my portfolio. Now, you know, I obviously could think greedy and say, well, if it goes higher, it's going to have an even bigger impact. Yes, it is. But if I take a really small position, and I put 2% of my portfolio into a stock and it goes up 10%, that's 0.2% on my performance. It doesn't move the needle. It doesn't move the needle. So concentration actually helps me sell into strength as far as me personally. The way that I can take a big position is simply because of the risk. So I'm only taking big positions when trades are working, I've got some traction. Usually I've already gotten profits on the smaller positions, and my stop is very tight. Now, I think you said something about maximum. Did you say I have a maximum 5% stop?
Yeah, no, I'm saying that you change
because I have a big, that's not my maximum stop, but I just wanted to make sure.
Yeah, no, I'm saying you never chase the stock from a breakout from more than 5%.
Don't chase. You're right. Don't chase the stocks. Yeah, extend it.
Yeah.
I don't chase the stocks more than 1%. So yeah, 1%. 5% was the old rule. That was in the back in the day. That was sort of the O'Neill rule. And some people would chase them up even 10%. And that was back when I first started. I would maybe chase a stock up 5%, but not in the last 25, 30 years. If I can't buy it virtually perfect, right at the breakout within 1%, maybe 2% with some slippage, then I'm leaving it alone. I'm not chasing it, and I'll just miss it. If that's what has to happen, then I just miss it. And that's the discipline.
Then how to reach that 25% position size in a single stock if you're not chasing?
Well, when you're, as rich as you are, it's hard because you have to take those big positions. I don't know what your trading account is now, but I remember you were moving some pretty big numbers really quickly. So you were a great success story. I'm so happy that I was able to be a little part of that. So look, with liquidity, people often ask me, well, if you've got these big returns, how come you're not a billionaire? Liquidity, that's why. And a respect for risk. I don't put all my my net worth into the stock market anymore. At one time I did. For a couple decades, every penny I had was in the stock market. And now it's a much smaller percentage. That's when you get to where you have a lot more money, that should be the problem, that you have a liquidity problem. And you do have you have a liquidity problem. So then you're going to have to just buy up until you can an amount that you can get out safely without affecting the price of the stock. Most people watching this are not going to have that problem. They're not, unless you're managing a hedge fund or a mutual fund, or you've got a very large trading account of tens of millions of dollars, and even that's relatively small. To this day, I take positions sometimes that are $10 million in one stock, and I still get out very expeditiously and are able to get my position on. It's got to be in a relatively liquid name, though, of course.
Okay, let me just take a follow-on answer from you. So what's the maximum percentage any stock has been part of your portfolio in recent times when your capital is large?
Well, I'm certainly, I don't want to, I'm going to tell you the truth, but I also want to say that I don't want to encourage this. And again, like when the U.S. Investing Championship year, I was 4x leverage in positions. I literally put the entire account, as much capital as I could possibly put. However, I had profits that I was working with. I had stops that were super tight. They were in liquid names, and I was not holding that overnight. Like I would usually trade out of that big overweight, and then if I was holding overnight, I would bring it down to a more reasonable position. So, and if you're just starting doing this or haven't been doing it for, you shouldn't even be using any leverage at all. I've been doing this for 40 years, so I'm able to manage that risk. And even with that, sometimes I get torpedoed. I mean, I've had days where I take big hits because I take that big position and it moves on me. Even a liquid position, it moves quickly. And the next thing you know, you're scrambling and you're underwater. So, but to answer your question, generally speaking, the big positions are going to be 25%. of the portfolio.
Okay.
And mathematically speaking, 25%, if you're a 2-to-1 trader, a true 2-to-1 trader, mathematically speaking, your optimal position size is 25%. So if you were to use something like optimal F or the Kelly formula, you can go in there and you can put your numbers in there. And if you're a 2-to-1 trader, that's going to kick back and it's going to say to you, 25% is your optimal position. So I just sort of anecdotally got to that number. I realized over years of trading that, wow, 25% is about enough where I've got really good exposure, but not too much exposure that if, stock goes against me 10%, it's 2.5% of my total equity, and I can still recover from that. The heat isn't too much. So that's sort of that optimal maximum point. The minimum point is usually 5 or 10%. But if the market's bad and I'm just trying to get my feel for the market, I might buy 100 shares of a stock and it might represent an absolutely minuscule portion, because I'm not really trying to make money at that point. I'm just trying to get my trading rhythm and to figure out the theme of the market. So it's going to range anywhere from negligible to 25% of the most conditions. Now, one last thing, during the USIC in 2021, I often tell people, why do football players, why do the linemen of the football players take steroids? Because the guy on the other side's got taken them, right? So if, I'm going to get mauled if I don't take steroids, because he's going to be stronger and bigger than me. So when you're in a contest like the U.S. Investing Championship, and the whole world is expecting you to do well because I've already won it, I'm against guys that are the prior years, you had some guys did 1,000% return, 900% return. So they didn't do that by taking small positions. They're taking huge positions and being very, very aggressive. So I had to do that too, to be able to compete.
Sure. Ashwin, because we have a limitation of time, I want to do my favorite section, the Indian charts. Is it okay? Can I share the screen?
Yeah, please.
So, Mark, we have curated 5 stocks only for you, where Ashwin had some positions. I don't know whether he's still carrying the positions or not. And he wanted me to discuss these 5 stocks with you and your theory of, analyzing these 5 stocks. So, Ashwin, would you take it over? First stock is Adani Enterprise.
And these are Indian stocks, right?
Yes, 5 Indian stocks.
Okay. So what would you like me to do? Analyze them as of right now, where they're trading right now, or in the past?
You can go with the past also, not an issue.
Well, there's only 2 spots I would buy, would have bought this, would have been in mid-July when it came out of that nice, well-formed base. You got a perfect VCP. Yep, right there on the right.
Yeah.
Yeah, coming right out of there. You go over maybe 4 or 5 bars to the right, was where I would be buying that. And then going in September, right at the just before September, maybe back right about there, coming out of there. And these are daily. These are daily bars, right?
Yeah. These are daily bars.
That's what I call a short stroke, where it's pretty brief, but maybe there. But other than that, that stock that's a super high alpha stock. It has almost no standard deviation and all upside. So that's exactly the type of stock that you want to be in.
Yes. Perfect.
All right. So, and what do I do now? Now that you mentioned that you would have probably exited here, right? So it's an exit now?
Well, I don't know. I mean, I don't know if where you bought it, but me personally, I mean, if a stock that ran up like that and then I bought it from that little short stroke, I would have already sold it into that strength probably.
Sure.
I would have been selling into strength, and then certainly after that big down day, and that next recovery day, you go back, go to the right off the high, the second day off the high, you had a big down day there. Nope, keep going all the way to the right off the very high.
Okay.
Yeah, that first big down day. I mean, if I had a big profit in it, and I was trying to protect my profit, that's where I probably would start taking some profits. Now, as it's changed its character there, that's the biggest down day you've had since the beginning of the move.
All right, that's interesting. Ashwin, you know what to do next. Okay. We have the other stock, one of the favorite stock, the Indian Tobacco Company, the largest tobacco manufacturers in India, ITC.
So that's another one that came off of a pretty nice little base there back in July. So I'd be buying it right there in the beginning of July. That's what I call a pause pivot. It only paused for 1 day. So you do have a VCP. I mean, I personally, I'd be interested in knowing when Ashwin bought these. But that would be the day that I would be buying that. And then it's, it moved up very efficiently. You had almost no volatility to the downside. So that's one that I probably would have just sold, into some strength. And as it's moving higher, just start scaling out into the strength. When you have a stock that acts so orderly like that, and it doesn't have much downside, those are good stocks to put a moving average behind them and just trail them. Once you get at a profit, now you just, put a moving average that contains the majority of the price action. And then when you get a close below it, start taking some profits there.
All right, Ashwin, when did you buy it?
So I buy the same point here only, once the breakout.
No wonder why you are the favorite student.
No wonder why he's a star student, right?
Yeah, he is indeed.
See, I didn't even know, but that's exactly where he bought it. So there you go. So that just goes to show, it is teachable, that you can, you can learn this and you can learn the same buy points as Mark Minervini of what I would do.
Yeah. So related to this buy point only, I really like power plays much, Mark. Most of the time I try to find power plays because there only you get the maximum return, risk versus reward. So from the low cheap or a handle breakout or a power, which is your favorite setup? You have a favorite setup?
So no, I don't really have a favorite because it's usually a function of the market. Like in 1995, I called it the year of the high tight flag. There was all power plays and high tight flags. And that year was one of my biggest years ever. I was up over 400% that year. It was a game-changing year for me at the time. And now there's other periods where, we had much bigger, like for instance, 1990 in the US, you had a bear market that looks similar to the bear market that we're in now, except the right side is starting to decouple and it's looking more like 1962 now. But up until just recently, it was looking very much like 1990. That's where there was lots of big cup with handles. And they were forming those cheats and those right sides, as I call them, the cheat areas. So it's a function of the market. So you have to, if you start having favorites, then what happens is you're waiting for something while something else is setting up. And you have to be very careful that, you're looking into the forest and you're missing the beautiful leaves that are on the trees because you're looking for something else, so make sure that you don't get stuck in a mindset that, this is my favorite, I'm going to wait for it, because it may not even happen. Meanwhile, there's another theme that's taking place. So that's why I have the low cheat, the handle, the power plays. So what I can guarantee you is there isn't going to be a bull market that's going to start that you're not going to get one or all of those. You're either going to get the cheat, the low cheat, the handle, the pullback to the breakout, or power plays. Some of those are going to show up. So I look at it as like I'm trying to get to, say, the 50th floor in a building. And so I want to be able to get on the 3rd floor, the 7th floor, the 12th floor, and the 15th floor. And maybe I get on the 15th floor, but I still got a pretty good ride to the 50th. If I get on the 7th floor, I got a bigger ride, but the elevator is going to stop on one of those floors or all of those floors. I'm going to get those opportunities. So that's how I cast my net. And then I just let the market tell me where to put the capital by what sets up and what proliferates.
Perfect.
Awesome. Let's go to one of the recent IPO stocks, Campus Activewear.
Right. I mean, I can almost certainly tell you where Ashwin bought this, either of one of several occasions, and it probably was in just going into August or just before August. It was probably right there.
Yeah, perfect. With volumes are also there, a lot of volumes.
Yep, volume came in. I mean, that's a perfect primary base setup. Yeah. You must have been licking your chops when you saw that one setting up, right?
Yeah.
You must have been getting very excited. If I saw that setting up, I would be getting very excited because that's a perfect setup. And then you had a cheat area you could bought over there in around August, I don't know, 15th or so, as it turned up from that little base. Then you had another breakout around September 12th, where you tightened up once again. And you notice how every single time it forms a VCP. So, this is universal. That's the other thing too. The way I approach the market is something that the strategy and the techniques are timeless. They've been working since the beginning of time, and they're going to work till the end of time. And that's a big difference about what I do and what someone like O'Neill does, is that what both of us, are doing or have done is timeless. There's some people that have strategies and it's based on astrology and, who wins the Super Bowl this year. It's all about longevity. Could it be consistent and be applied, every decade, every century, and over that longer period of time, this what I do is timeless.
Awesome. So quickly, let me go to the next one. Indian hotel, which owns the Taj properties, one of the top hospitality companies in India.
Mm-hmm. Yeah, so I could have maybe made a case for buying it around July.
Okay.
I guess that's July 5th or so, and then maybe buying it over a little bit later, getting closer to the 18th, coming out of that base right there. Then now recently it accelerated in September. The rate of acceleration went up, and you got a good number of days there where it was up versus being down.
Yep.
That looked like that was starting to get a bit exhaustive in the short term, but the stock still looks pretty, really strong here. So would have maybe sold into that strength if I was a swing trader.
Yeah.
All right. Mark, will you ever enter these stocks again if these are available at lower rates, or you will shift your strategy to some other stocks which has opportunity that time?
So I often say sometimes the best stock that you can buy is the one that you already own, or the one that you just previously owned. So absolutely, I'll buy back in if it sets up again and the technical action sets up, because you can have a stock that can go up 1,000% and set up 4 or 5 times during that time. Yahoo is a perfect example. In 1997, I bought Yahoo off of almost an exact situation like we just saw in that previous name. I don't know if it was Campus or the ITC, the one that was the primary base in 97. And I don't know if you can bring that up and go back to 97, but Yahoo then went up 8,000% from there. And I didn't make 8,000%, but I made a lot of money in it. I made 100% in it, then I made 60%, I made 30%. And when you compound it all together, it was the equivalent of holding for a big move in Yahoo. But I had traded it from base after base after base and sold it into strength, and just and compounded those various trades.
All right.
So do you have any time frame which you trade the most, weeklies or dailies?
Weekly or daily using the charts as far as the weekly or the daily time frame? Well, I always look at the daily and the weekly, so I want it to look good on both.
And in one of your interview in Trader Line, you mentioned that you use intraday charts as well in live market hours. So it's just to watch your stocks, or you screen the stock as well in live market?
In what market?
Live market, in active market.
I'm sorry, I can't really understand it. Yeah. You got me on your accent on this one.
So, in one of your interviews with Trader Line, you mentioned that you look at live market chart as well, especially a 5-minute chart. So do you use them to identify stocks? Or
You're saying the intraday charts?
Yeah.
Oh, so like a 1 minute or a 5 minute?
Yeah.
I don't even when I short-term trade, I'm not looking at the intraday. I'm not trading off the intradays. I'm still trading off the daily. Even my short-term trading is off the daily.
Okay, perfect.
Yeah.
So one last question, Mark, from my side, that you have trained thousands of participants, traders in your workshop, and what type of preparation would you like to see in the traders before attending to, or before starting to your workshop, before coming to a workshop?
A preparation before the workshop?
Yeah.
Well, I mean, you don't have to prepare for anything. I mean, you just come with an open mind and you know, and a understanding that you're going to be drinking from a fire hose, as you know. It's a lot of information. You know, it's the most comprehensive workshop probably anywhere in the world. So it's A to Z. It is advanced, you know, although we do break things down, and I think, you know, even someone who has never traded stocks before would be able to understand it. But the best thing to do is to read my books as many times as possible, because then you're familiar with a lot of the lingo and a lot of the things that I'm going to discuss. And many of the things I discuss are in the books, but we certainly add a lot more, you know, talking about them and bring out all the nuances and then of course with the Q&A sessions and so forth. This particular year too, you know, I've done it, of course, you know, with David Ryan. You came when David Ryan was there, right? Yeah. So David Ryan was with me, I don't remember, 7 or 8 years out of doing it for 12 or 13 years. But this year, Mark Ritchie, who is my, you know, my right-hand man at Minervini Private Access, and who has had a tremendous performance and a career. In 12 years, he's only had a drawdown of 5 or 6% 3 times. You know, and that averaged 42% a year over that time. And that's his blended money with managed money too. If you take just his personal money, he's turned about like $100,000, like 25 million. So he's just a, you know, a huge success and knows this as good as anybody. Probably the next best thing to me. And he's my co-instructor this year. So the preparation would be, you know, to read up on everything that, you know, I have in my books. And maybe if you want to learn a little bit more Mark Ritchie, you can read Momentum Masters, since that's where he's interviewed.
Awesome. In fact, I got a privilege to record face-to-face with Mark Ritchie as well. And you know, that time I realized that if student has done such wonderful work, the master will be awesome. So it's a great pleasure for me to talk with you today.
I didn't even know that. That's wonderful. So you did an interview with Mark Ritchie, you're saying?
Yes, I did.
Okay. Oh, that's awesome. Great. All right. I'll have to ask him about that tomorrow.
Thank you, Mark. I mean, obviously, I hate to end this, but you have given us the time, and you have actually given us more time than it was scheduled. I can't thank you enough for this amazing session. Thank you so much, Mark. And Ashwin, would you like to close it?
Yeah, thank you, Mark. I must say I attended hundreds of seminars worldwide, but what I attended in 2017 changed my life. It's one of the best content you presented there, and thank you for your time today. You took my words to Vivek Bhai, and thank you for everything, Mark. Thank you.
Oh, you're quite
welcome. Keep guiding. Thank you. Keep guiding.
You're a great ambassador. You've done a great job. I'm very, very proud of you, and keep doing great. And we'll talk again.
My pleasure. Thank you.
Thank you, Mark. Have a great day. Good night.
All right, guys. Take care. Bye-bye. Thank you.
Bye.
Bye.